The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast. We would appreciate it if you would hit that subscribe button so you'll get all of these as they are released. And if you have any friends or family or coworkers you think might appreciate a look at these, we would really thank you if you would forward that on to them so they can see that. We also have a monthly investment webinar coming up February 1st. You can sign up for that, register at our website, which is iriradio.com. That's iriradio.com. It's going to be we have one at the beginning of every month, update on the markets, little education about things that are going on, and give you a heads up about kind of where we are and where we think we're headed. Thank you.
So today, since we're still at the beginning of the year, we're going to talk a little bit about the forecast that everybody wants. Now, we don't forecast.
They're out there, man. Yep.
What we understand is we do not know the future, and we have yet to meet somebody who does. But from time to time, there are people who do make forecasts, and the Lord blesses them with events that make them look genius.
And there you go.
And that happens to everybody. Basically, what we're looking for in a forecast is I want my on-off switch. Should I be in the market or should I be out? What should I own? When should I buy it, and when should I change and get rid of it? It's kind of like walking into my kitchen. I have a panel light switch that has 3 different switches in there. I want to know which one to turn on for the circumstances that I'm facing at that particular moment. And that's what investors are looking for. That's why they look at forecasts. And it's a major marketing tool for the financial services industry and media in general as we come into the year. And even as we move through the year, you'll forget about the ones that are wrong, and they'll deal with, yeah, but things are different now, so the forecast is now this.
Which means it doesn't matter if it doesn't actually matter if you're right or wrong. The important thing is to make an audacious forecast and make sure you get a lot of clicks on that. Make sure you get a lot of views on your podcast. Make sure you get a lot of subscribers to your email. It doesn't really matter. Later on, you can explain it away if it never happens, which most of the time it doesn't, but occasionally you're going to be spot on and you're going to extol yourself as a massive market maven, and you know exactly what's going on most of the time, which is never true.
So for a corollary, just think of the political forecast that we went through this last year.
Sure.
Trump was not going to win until he did. And then we know how Trump's going to do because he's been president before, until he got into office and issued 200 some odd executive orders in the matter of a couple of days. And all the smart money in Davos was shocked at his presentation. Whatever was forecast was unknown. And the response now is, how do we realign ourselves? And that's the same problem that major analysts and money managers have. If you're betting on the forecast, often the odds are really against you, and you have to take really big risk. And the one that comes to mind is Michael Burry, who was portrayed in the movie The Big Short. And what did he do? In the top of the real estate market back in 06, 7, and 8, he said, this can't last. Now, managing a hedge fund, he started shorting the companies that were supporting that market, the real estate market as it rose, saying this can't last, this has to collapse. And if you watch the movie The Big Short, you know that at the high of the market, when he was deeply underwater, not only was he an emotional basket case, but his partners were too. He was going to bankrupt the firm.
The firm was definitely concerned about that. Yeah, they were worried that they were in big trouble. They didn't necessarily believe what he was saying because he was taking an extreme position, and it turned out in that instance he got that right. He was on the right side of that when everything collapsed. But they got more and more worried, as they said at the time. The theater keeps getting more and more crowded, but the exit door is still the same. So when everybody tries to get out at the same time, that can be a problem. If this moves against us, we're stuck. And once that became clear, they got very nervous. But he was right about the Big Short. It did collapse, and they did profit handsomely in that case.
Well, so he had to take big risk in order to do that, and
Yeah.
basically bet the farm, as the old saying goes. And he made money. Well, when the market did finally collapse and bottomed out in March of '09, it had impact globally. And other hedge funds and major players in the financial markets took another big bet and started buying Greek bonds.
Right.
Greek bonds? I mean, Perry, we were standing around in our office talking about that at the time. Uh,
Yep.
yeah, we had Dan there with us at the time, and we're saying this is just amazing. But as an average investor and a typical asset manager, financial planner, there wasn't really any way for us to access Greek bonds, but the return on them was substantial. Well, just like Michael Burry had to wait a few years to be proven right, those Greek bonds are now beginning to pay off. So that's '09 to, if you don't mind waiting 15 years to make your money, some of these things can make you rich, but you probably should be rich to begin with before you take that kind of risk. One of the other names that comes to mind, a lot of people are familiar with, is Elaine Garzarelli. We were running a market that was on its last legs back in '87.
Right.
And I remember counseling clients coming in. I was putting them in bonds. Bonds are a really better buy, and we should be buying bonds. But they just simply could not handle not owning stocks with the stock market going up as much as it was. And
Right.
coming in the summer and saying, I don't care if bonds are a better buy, I want to own those stocks. So under client direction, we put it back in the market. But Elaine Gazzarelli over at Shearson was saying to her clients, this market makes no sense. We shouldn't be in stocks. And she was moving people out of the market into defensive positions. And then October 13 of '87, Monday, October 13th, Black Monday, and the market tanks 30% in 90 days. 90 days, you're down 30%. December 4th, the market turns around. That was the absolute bottom of that. Well, she got a lot of press because she was right. She was outside. She was going against management and taking her clients out of the market. And if you're with a major financial firm, Shearson doesn't exist anymore. It's been acquired. But I mean, just think of major firms that still do. Merrill Lynch, J.P. Morgan, to name a few. Um, their job is to keep you invested. And what she was doing was the exact opposite, getting people out of those investments. And the manager's saying, you can't do that. You can't do that. Well, I'm talking to my clients and they're saying that's what they want to do. So, but under
Right.
her direction, of course. And if you think that's a problem, I mean, I have a late nephew. I mean, died of cancer. He was a mucky muck in his local branch office of Wells Fargo. And we were talking about this several years ago. And he said, I can't put clients in cash without written authorization from them if it's more than 30% of the account, because the manager will come in and tell me I have to invest the money.
There you
So
go.
you have a potential conflict of interest with your advisor if you're in a situation where you're actually custodying and dealing with a manager or an advisor who's at a major brokerage firm, as Elaine Garzarelli was back in '87. But she did get her people out of the market. And when the market tanked in October of '87, she got tons of press, and the whole office wants to know, how did you do that? What did you do? Where did you get that information? And I don't remember what her answer was. That it doesn't matter. She was a hero. The problem is that after the market bottomed in December of '87, it was 2 more years before she changed her mind about being exposed to equities. Now think about that.
Yep.
1987, the next year is 1988. 2 years later, you're in 1990. And the first 6 months of 1990 was a decent time to be in the market. It wasn't exceptional. It wasn't a rocket ship, but it wasn't going in the tank until July when we had the initial Gulf War and it looked like we were going to invade Kuwait. And the market tanked 30% again. So she won in 87. She was on the wrong side for 2 years. And by the time she changed her mind, it was just in time to see another 30% drop. So you have to be really careful with forecasting.
You
It
do, and you
has,
have to, yeah, never believe your own headlines. And if she had just trusted herself, it was her own data that she was using that said, "Hey, it's time to get these people out of the market." As you said, now this market doesn't make any sense. Let's get to the sidelines. And she did. When that turned around and the market was heading back up, she didn't trust it. She didn't trust the data, and her narrative was too strong. It had been a big winner. You hate to shift away from that, and people get caught in that trap all the time. Either this is done very well as a holding, I'm never going to sell it, or it's done very poorly, I'm never going to buy it again. And it's much more important to track the data, see what's happening now, not what's happened in the past. That is much less important than how things are performing currently, and make a decision based on that. And get the narrative out of the way, get your expectations out of the way, and believe the market for what it's doing. Look at the numbers, follow the money, and that's the best way to stay on the right side of trades.
so most people building a typical portfolio that is based on modern portfolio theory, and the average of which is around a 60% stock exposure and a 40% bond exposure. Not that
Right,
bonds are expected to make money, which over the last 4 years they haven't.
right,
But that's a typical portfolio, and it looks back over broad, long periods of time. Depending upon the index, if it's a U.S. market, it looks back typically into the 20s. If it's international stock, maybe it's only going back into the 70s. But it's in averaging those returns and saying that's how we're going to manage risk. Well, if you're going to deal with today, you still need data. The only data that's real is history. So your question is, how far back do you look? We generally look back over the last month. We will look longer given the circumstances of the decision we're trying to make. Different plans will either use daily data, weekly data, or monthly data, again, based on your perspective and your investment objective. How are you going to make those decisions? You need to understand how that decision is being made, how much data is being used. If you're looking at data that goes back to the 20s, it means that you're basically willing to accept 20-year periods of bear markets. Oh, 20-year bear market? Yeah, that's what I said. You look at 1929, the market didn't really recover. It had a couple of attempts, but it wasn't until we got done with World War II before the market really had legs and began to move higher on a persistent basis with interruptions along the way. What's your objective? How are you going to make decisions? What are your rules? And will you follow them? If you can't answer those questions, you probably need help. You can contact us.
absolutely.
That's what we do. Since this makes sense to you, you probably have friends, family, co-workers who might want to listen to it also. We'd appreciate it if you would share the link for this particular podcast. And if you want an update on what we see going on in the stock market, register for our February 1st or our first of month, first Saturday of every month. We do a stock market update webinar. Go to our website, iriradio.com. Register. They're free. Take an hour of your day on a Saturday morning. Learn a lot about general information on the market, plus market-specific data that we think should be universally useful for people who are in attendance. Thanks for listening. Subscribe to the website. We'll see you again on another episode. Have a great day.